What's up, everybody? My largest holding is Kohl's, and they just reported earnings this morning, and it was a pretty decent earnings report. The stock is up over 30% right now, and we've been talking about this stock here since May. My average buy price on this is about $8 a share. I started buying this when it dropped down to the 9s, and I bought all the way down to the 6s. My thesis was pretty simple. This was a company which at the time was trading for either $1 billion to $700-ish million, depending on when in here you want to look. And they were still very cash flow positive, hundreds of millions of dollars in cash flow a year. We'll take a look at their statements in a moment. On top of this, they're sitting on a bunch of real estate. They own more than 400 of their stores. Most of these stores are in pretty decent quality suburban areas outside of, mid-sized US cities. I thought even in bankruptcy, Kohl's was probably worth more than what they were trading for. And I didn't think that they were going bankrupt. Again, they were very cash flow positive. And you weren't quite seeing that reflected in just their earnings. Because they own so much real estate, they have a massive amount of depreciation, and that is a non-cash expense. It made their earnings look artificially low. On a cash flow basis, they didn't look that bad. I didn't think that this was some amazing company. I still don't. In fact, I've said in multiple videos, I think that Kohl's is a low quality business. They don't have a huge competitive advantage. They don't have a moat. They simply were just too cheap. Now, we're going to get into the numbers. We're going to go through this earnings report, and I'm going to let you know what I'm doing with my position. As always, if you get value out of the video, subscribe to the channel. Nothing in here is advice to buy or sell Kohl's. I just give you my thoughts, and I tell you what I'm doing with my money. Now, let's start. And we should mention Kohl's has a new CEO. This guy, Michael Bender, is now officially the CEO. The CEO position at Kohl's has been a bit of a revolving door. They've gone through a number of CEOs in the past few years. We've had Michelle Gass, we had Kingsbury for a couple years. Earlier this year, we had Ashley Buchanan, who was CEO for basically the shortest amount of time I think anyone has ever been CEO. I think he was in there for just a couple months. He was kicked out after siphoning off some Kohl's contracts to his girlfriend. And then the board put Michael Bender in there as interim CEO until they found someone else. But turns out Kohl's has been doing pretty okay the past couple quarters. So why fix what ain't broke? If Michael Bender is running a decent ship over there, then keep the guy in. He says, "We are pleased with Kohl's third quarter results, marking a third consecutive quarter of delivering top line and bottom line performance ahead of expectations." Now, he's right. Kohl's results have been coming in above expectations, but I just want to let you know what numbers we're actually talking about here. Kohl's for this quarter, year over year, their top line is down about 3%. Now, they closed a couple stores, so comparable sales are down about 2% year over year. Their revenue is down, and they're saying they're outperforming, and the stock has gone up a ton today, up over 30% again. In the grand scheme of things, this still isn't a great picture for Kohl's. Revenue is still down. It's just that the expectations were so low. In my opinion, this is the case of a company where the market thought that they were completely dead. They were being priced as if this was basically the worst company out there. And my thesis is simply that Kohl's is just a below average company. They are just mediocre. Now, that might not sound like some great ringing endorsement of Kohl's, but when everyone thinks that you're horrible and it turns out that you're just mediocre, yeah, you can have your stock price more than triple here. Now, continuing on, a bit of good news, gross margin up a bit, up about 50 basis points. This is because they've been focusing more on their proprietary brands this year. These are the things that you can only get on Kohl's. These are the brands that Kohl's either owns or they have some exclusive license for, like with Lauren Conrad or Vera Wang. Their margins here on these products are better. And also at the same time, SG&A expense down 2% year over year. We saw a similar thing in the second quarter for Kohl's as well. They've done a decent job lowering their expenses. So they don't have growth. In fact, yeah, top line is still down, but you know what? Their expenses are down too. They're doing an okay job keeping the expenses in line. The result is adjusted operating income of $77 million a share. The adjustment is just for the couple stores that they close. Kohl's adjustments are actually very reasonable. There's not much crazy in this earnings report. It's just a bunch of getting back to retail basics, focusing on the brands that are working, focusing on the segments that are working, impulse cues, also Sephora. Sephora is now in almost every Kohl's store. They're not reinventing the wheel here. It just turns out that Kohl's isn't quite as bad as most people thought. Looking at their guidance for the full year, they're still guiding for comparable sales to be down 2.5% to 3%. But because they've done a decent job keeping costs in line, managing inventory, their adjusted EPS is now, they're saying $1.25 to $1.45. Previously, at the beginning of the year, they were basically guiding for nothing for the year. I think this number was like 10 cents to 50 cents. So this is a significant increase. Now, you might be saying, okay, let's just call this, $1.35. If we just look at the stock again right now, it's trading for about $21 a share. So that's something like 15 to 16 times earnings right now. I mean, that doesn't really seem like Kohl's is some great deal, especially since we said that Kohl's is a low quality business. Their sales on the top line are declining. Do we really want to pay 15 to 16 times sales for Kohl's? Well, first of all, I was buying obviously when it was much cheaper. We'll talk about what I'm doing today now that the price has gone up. But I think actually just focusing on this earnings per share number is actually missing the big picture of what's going on with Kohl's. We should look at the cash flow statement. Again, because Kohl's has a ton of depreciation from all of the stores that are on their books, then the earnings are going to be depressed from that depreciation. We see just the 3 months in this quarter, depreciation expense about $180 million. If we look at the cash flow statement, through the first 3 quarters, first 9 months of this year, they have operating cash flow of over $600 million. CapEx is down a bit from last year as they've now finished building out pretty much all of their Sephoras. Subtracting out CapEx, you have over $300 million of free cash flow. And this is just the first 3 quarters. Most of the cash flow for a retailer comes in quarter 4, comes during those holidays. If we look at adjusted free cash flow, which again, Kohl's adjustments, very reasonable, we're down to $270 million in free cash flow for the first 3 quarters of the year. Again, even after the huge jump up in price this morning, Kohl's is like a $2.4 billion company. When you look at Kohl's relative to the cash flow, it actually still looks a bit cheap. And what have they been doing with all of this cash? Well, here's where I want to go over to their balance sheet. So let's pop this out over here. Let's go down. I'm just going to scroll all the way down to wherever their balance sheet is. All right, here we go. I think we need to give a little bit of advice to whoever formatted this table right here. It doesn't really look that great, but in any case, we're comparing their balance sheet today versus their balance sheet 1 year ago. Something that's very scary when you have a company with declining top line sales is if they have a lot of debt and they have low margins, then instantly you're thinking, is this company at risk of just going bankrupt? Well, taking a look at their debt, a year ago, they had long-term debt of about $1.2 billion, plus the current portion of that of, $350 million, plus the borrowings on their revolver of about $750 million. You add all that up, you're going to get to about, $2.3 billion in debt. They also have their leases, and yes, that's a liability, but it's not really debt in the same way. We're talking about interest-bearing debt right here. And a year ago, $2.2 to $2.3 billion in debt. What's that number like today? Well, there is no longer any current portion of that long-term debt anymore. They rolled that debt out. They have no maturities coming for several years now. Their long-term debt is sitting at about $1.5 billion. And as far as their revolver, they've only borrowed $45 million on that. So you add this up, you're $1.5 to $1.6 billion now in debt. This company has been using their cash to be paying down their borrowings massively. I know many shareholders look at Kohl's and they would like to see the company buying back stock or using that capital to return it to shareholders. But for me, I see the main problem as their debt, and I'm happy that they're using cash to pay it down. Now, maybe when the stock was down here at, $6, $7, $8 a share, yeah, maybe then finding a way to use cash to buy back stock would have been great. But, that's neither here nor there. Here we are now. Cash is going towards debt. On the earnings call this morning, they said that this borrowing facility from the credit revolver, this is going to be gone by the end of the year. Frankly, I would love to see them pay down more of this long-term debt as well for the next few quarters also, but they have no near-term maturities now. Here's a 2029 Kohl's bond. We see that the bond prices have been moving up over the past few months. If I just look over the past 6 months, bond price up, bond yield down. Essentially, this is the bond market telling us that they are pricing a lower credit risk to Kohl's than they were, earlier in the year. These are still pretty high yields. You're looking at an effective 10% yield right now on this bond. This one over here, closer to 11%. So Kohl's is getting a great return on their investment using their cash to buy back this debt. The more debt you buy back, that's less interest that you have to pay. And it also means you're just a less risky company. You de-lever the balance sheet, you lower the bankruptcy risk, you lower the credit risk, and you're going to see that reflected in the stock price. Now, as far as what I'm doing today, as far as where I see value for Kohl's in the future, typically when I'm looking at a company, I make these little spreadsheets. I'm sure if you follow the channel, you've seen them. They're a very nice way for me to get a sense of where the risk and reward is for a company. But, I actually don't have one for Kohl's. There are some stocks that you look at sometimes and you just don't need to put numbers in a spreadsheet. You could do the math in your head. You could do the math on the back of a napkin. Kohl's was a special situation. It was a company that was trading for, at the time that I was buying it, between $700 million and $1 billion. Even with declining top-line sales, I simply thought, given their cash flow potential, the market was just way too bearish on Kohl's. Everyone was on one side of this trade. No one liked the stock. I don't think anyone was making videos on it on YouTube. Maybe some people are talking about it now that it's up so much. It's a company that's a bit difficult to see the value from just a spreadsheet alone. If I just put this in here, first of all, you see the price decline. I mean, they were trading at, $60-ish a share. They had buyout offers for around $60-ish a share in 2021 that they said no to. We see here revenue had been pretty stagnant, declining recently. I think another thing that has been a boost for Kohl's is, everyone got scared when tariffs were introduced. In fact, it was April when tariffs were introduced that Kohl's hit their low of $6 a share. But as part of this whole trade policy, the de minimis exemption, if you were buying something on Shein or Temu and it got shipped to the US, you weren't getting tariffed on that product. As we've seen the rise of these discount Chinese retailers in the past 5 years, you saw Kohl's revenue decline. Now that those Temu goods are getting taxed, I think that's a tailwind for Kohl's that a lot of people didn't talk about. If we go down to my model and we just put in some assumptions about the future, again, it's going to be difficult to see value if you're not really looking at the cash flow. But, if I just put in down 3% a year for revenue on the top line, maybe they get back to 4% margins. That might already be a little bit optimistic. I'll give them 2.5% free cash flow margin. This represents some money that's either coming back to shareholders or to the debt holders in some way. Then we already see with a 10 times multiple, you're only looking at a 10% annualized return. And for a company with declining top line revenue, I would typically put in a single digit multiple here. What's really affecting and distorting this number, you see if I put in an 8 times multiple, you're now at no return over 5 years. But what's really affecting this number is the net debt, which a lot of that now is leases. We're looking at net debt here of $3.8 billion. But we just saw by looking at their balance sheet that the debt is actually only $1.5 billion. My model is treating the liability of leases here the same as it's treating interest-bearing debt. That's probably not a realistic way to look at value for this business. And we see, according to the model, it doesn't look like there's any value here. But if we just look at free cash flow, again, first 3 quarters, they had $270 million in free cash flow. And on the call, they said, we remain on track to achieve $1.3 billion of operating cash flow and $900 million of free cash flow at the end of this fiscal year. Again, for most retailers, quarter 4 is kind of where they make all their money. The holidays are big time for a company like Kohl's, and they're saying $900 million in free cash flow for this fiscal year. By that measure, you could argue that the stock is still dirt cheap. In any case, what am I actually doing here with my money? Well, my opinion on just the value of Kohl's, I don't think that Kohl's shares are overvalued today, even after the price going up. However, obviously, the risk reward is not as good at $21 than it was when it was in the single digits. As the price goes up, so does the risk, and the reward goes down. Now, with that said, operationally, this quarter was actually better than I thought it was going to be. They've done well, but I'm not sure if Kohl's is offering the best risk reward in the market, and this is by far my largest position now, especially with the price increasing today. I still think this is a low quality business with essentially no moat. And frankly, I'm not comfortable with how large of a position this has become in my portfolio. On the other side of that coin, I don't really want to take such a massive short-term gain in this calendar year. I bought pretty much all of my position in March and April, and I would like to make it until next April before I sell to simply have better tax treatment on this gain. So what I've decided to do is I've sold some covered calls on a significant amount of my position. If you're interested, the calls I sold expire in April of next year, and a lot of them were at a $25 strike price. Some of them were at other prices, but mostly you can think that I sold essentially $25 strike calls for April of next year. The volatility on Kohl's is fairly high, so I'm collecting a fairly decent premium and just putting that in my pocket today. If these calls are exercised, if Kohl's is over $25 at that time, then essentially the result to me is I will be selling Kohl's at between $27 and $28. Frankly, that will still be a little bit of a discount to what I think the company is worth, but again, for such a low quality business, I like to have a large margin of safety. For a higher quality business, something like a Google or an Amazon, I'm okay holding on even if I think that the price has gotten over what I think fair value is. But for a low quality business, frankly, I'm not interested in waiting until it gets to what I think is fair value. If I'm buying the business for like 20% of fair value, and then once it gets up to, 70 or 80% of what I think a reasonable estimate of fair value is, I'm happy taking my gains. That's just my thoughts. If you own Kohl's, let me know what you think. Let me know what you thought of the earnings. Do you agree or disagree with anything I said in this video? As always, if you got value here, subscribe to the channel. If you want to make spreadsheets like the one I have here, where you can just put in any ticker and make something like what I show on this channel, then consider following me on Patreon. Link to that will be down below. Again, nothing in here was advice for you to buy or sell Kohl's or buy or sell any of these options. I'm just giving you my thoughts, and I tell you what I'm doing with my money, and I hope to see you all in another video.